Badger Loans podcast. This one is on what is a loan and 5 good reasons for taking one out. So it's a 2-part blog post, and I'm also putting it up on YouTube as well. Nothing exciting, just me talking to a camera, but sometimes it's nice to have something else to look at, and of course you get to look around my front room as well. So and please no, I don't need comments on my front room. What is a loan and why take one out? So it may seem a bit obvious to many of us, but it may seem like, what's the point? But there will be people hopefully watching and listening that have never taken a loan out, or have only had one, or have just left school or something else, and they don't know what one is, or the technical terms about them, or the terminology. So it was just worth doing, really. So I'll follow the blog post in a loose way and do it over 2 parts. So the next part will be 5 great reasons for taking out a loan, and there are some good reasons for taking out a loan. There's some awful reasons as well, but we'll try and focus on a bit of both. So, what is a loan? As far as we're concerned, a loan is a loan is a loan. By we, I mean Badger Loans. Loans differ only in terms of the amount that you're borrowing, the term you're borrowing them for, and the interest rate. So that's it: amount, term, and rate. And they will be, you will pick how long you want it over, whether you want it over 2 months if it's a payday loan, or 2 years if it's a personal loan. The rate will be set by the lender, and the rate will be based on their view of you as a risk. So if they think you're very likely to pay it back with no problems and no issues, you will get the lowest rate available. If they think you could be a problem because you're young, you've not had one before, you don't really know how it works, you don't have the commitment levels or the responsibility to see through a 2 or 3 year loan, making a payment every month for 24 or 36 months, then you will get a high interest rate, and that is their reflection of you as a credit risk. Nothing else. Doesn't say you're a bad person or anything like that. Just that's their view of you as a credit risk. It's going to be high if you've not had a loan before, because no one can say what you're going to be like. So that's a loan. Differs by term, rate, and amount, of course. So having said a loan is a loan is a loan, and that there's no difference between them, you would be within your rights to ask, so why are there so many different names for them? You've got personal loans, installment loans, short-term loans, payday loans. It's just marketing, really. There's no other reason. Although, because payday loans became so popular and were so toxic, the FCA, the Financial Conduct Authority, who regulate this consumer credit industry, they decided they should define a payday loan. So they defined a payday loan as being a loan of under £1,000 for a duration of a year or less, and with an APR of 100% or more. Now, if you've read our blog post on why APR is no use for short-term loans, you'll know that it's just rubbish, really. You can't use APRs to compare a loan of under 1 year when the whole point of an APR is it's an annual percentage rate. I'm going to quickly veer off here, because I once did a loan for someone and the APR was 30,000% because it was a 6-week loan and it was only 100 quid. I charged her 60 quid. Dropped it during it because it looked like she was going to pay it back all on time. The reason the APR is 30,000% is because the way you work it out is so the loan was, say, for 10 weeks. So you assume that the customer pays their loan for 10 weeks and then continues to pay the loan for another 42 weeks to get up to the year, even though they've paid it back after 10. And that's why you end up with all these ridiculous rates of 1,000%, 2,000%. And it's given the payday loan, for that reason, wrongly, a bad name. And yet no one seems to know this. It's just not widely known at all that that's how you get an APR. You've got to take it over the whole year. And, the 3-month loan, well, it's going to have a couple of thousand APR percent, because for the very reason. You've got to then count another 9 months on top of it. Another 9 months on top of it of paying back a loan you've already paid back after month 3. Anyway, that's APRs. Different blog post entirely. So a loan is a loan is a loan. You have within the loans, and there's no difference between them, are the two different loans. That's a secured loan or an unsecured loan. Guarantor loans are also a different type of loan, but they're either going to be secured or unsecured. So we deal in unsecured loans. This is all about unsecured loans. It means that you're lent the money on good faith that you're going to pay it back. Otherwise, a secured loan is a loan that is secured on collateral, usually your property, but could be a car, could be a piece of jewelry, could be anything worth something that you can use as security, but it's usually a house, and typically it's what's called a second charge. A mortgage is called a first charge, and a secured loan would generally be called a second charge, but it could be the third or fourth one if they've got lots of loans on the property. So all these names, short-term loans, installment loans, etc., all really just marketing terms. And they, because we're human beings, we like to label things. We like to be able to differentiate between things. And that's just one way of differentiating between, finding your needs as a consumer by directing you to a short-term installment loan. It does what it says, really. So that's it. There's not an awful lot more to say about what is a loan. We've ascertained what there is. There's no difference between them, really, not really. So now we move on to why take one out in the first place. I'm going to give you 5 good reasons, and there's some crackers in there as well. So make sure you come back for the next bit. Thanks for listening, or thanks for watching. Sorry, it's a bit of an experience if you're watching, but there we go. First one. See you soon. Bye bye.